Do you want to invest in the next tech giant set to change the world? Or are you more inclined to discover hidden treasures in the stock market? If you want to find out, then keep watching. I'm Jack of all trades, and today we're going to explore the differences between growth and value investing. We will start with growth, follow up with value, and finish up with the comparison. Strap in, because this is where the thrilling journey begins. Enjoy the video. Investing in growth companies. Growth investing is a strategy that involves investing in companies that are expected to experience above average growth. These companies are often characterized by rapid revenue and profit expansion, driven by factors such as technological innovation and market expansion. A well-known example of a growth company is Tesla. The revenue has more than tripled in 3 years. The following characteristics will help you recognize a growth company. High revenue and earnings growth. Growth companies typically exhibit a history of robust revenue and earnings growth. Investors are attracted to these companies because they anticipate future profits will continue to rise at an accelerated rate. Innovation and disruption. Many growth companies are at the forefront of innovation and often disrupt established industries with groundbreaking technologies or business models. Think of companies like Amazon, Apple, or Tesla, which revolutionized their respective industries. High price to earnings ratios. Due to their growth potential, growth companies often have high PE ratios. The PE ratio is the stock price of a company divided by its earnings. If the PE is high, it means you are paying a lot for $1 of profit, and if it is low, then you are paying little. Investors are willing to pay a higher price if the future earnings are going to be a lot higher. Limited or no dividends. Dividend is money that leaves the company and is paid out to the shareholders. Growth companies typically reinvest their earnings back into the business to fuel further expansion, so they may not pay dividends or only just a small amount. Advantages and disadvantages of investing in growth companies. Investing in growth companies has several advantages. First of all, you have a potential for higher returns because of the expected growth. Second of all, you ride the wave of innovation, which leads to that growth. Third of all, by adding growth stocks to your portfolio, you diversify your portfolio, when your current portfolio is full of safer stocks. There are also disadvantages. Investing in growth companies has a higher risk. Growth stocks can be volatile and are more susceptible to market downturns. If growth expectations are not met, the stock price can plummet. Another disadvantage is that growth stocks often do not provide income in the form of dividends, which can be a drawback for income-focused investors. Investing in value companies. Value investing is a strategy that focuses on finding and investing in companies whose stock prices are currently trading at a discount to their intrinsic value or fair value. In my previous video about price versus value, I elaborated on this topic. A link should be available on screen now. Check it out if you want to find out more. Value investors believe that the market occasionally undervalues certain stocks due to short-term factors or market sentiment, providing an opportunity to buy these stocks at a bargain. The following characteristics will help you recognize a value company. Relatively low price to earnings ratio. Value stocks typically have lower PE ratios compared to growth stocks. This indicates that their stock prices are relatively cheap in relation to their current earnings. Investors are usually not willing to pay a big premium if the future earnings are not growing as much anymore. If the company has a good competitive advantage, then the future earnings are more secure than when the competition is high. Investors are usually willing to pay more for these types of companies, so within the group of value companies, there is still a big diversity. Well-known examples of companies with a good competitive advantage in this category are Coca-Cola and McDonald's. Stable earnings and dividends. Value companies often have a history of consistent earnings and may pay dividends regularly. These characteristics provide a sense of stability, especially if that company has proven to be able to pay out dividends over several market cycles. Then this is proof that the company can perform well under different market conditions. Advantages and disadvantages of investing in value companies. Investing in value companies has several advantages. They have lower volatility, which can be beneficial for risk-averse investors. Value stocks often pay dividends, making them attractive to income-seeking investors who want regular cash flow. And value investors aim to buy stocks at a price significantly below their intrinsic value. This provides a safety margin that can help protect against losses if the stock price experiences a temporary decline. There are also disadvantages to value investing. They have limited growth potential. Value stocks may not experience rapid price appreciation when the earnings and revenues are stable. The potential for big gains may be lower than with growth stocks. And there's also risk. Some value stocks have a lower price for a reason. They may be struggling companies facing long-term challenges, making them value traps that never recover. Choosing between growth and value investing. The choice between growth and value investing depends on your individual financial goals, risk tolerance, and investment horizon. Growth investing is suitable for those who are willing to take on higher risk for the potential of significant capital appreciation. It's often favored by younger investors with a longer time horizon. Value investing is favored by those who prioritize safety and steady income. It's often associated with a more conservative approach to investing and can be suitable for income-focused or risk-averse investors. Many investors adopt a balanced approach, blending growth and value stocks in their portfolio to achieve diversification and a mix of potential returns and stability. This is the approach that I adopt myself as well. Thank you for watching my video. If you want to see more of my content in the future, then please help me out and press like and subscribe. Thank you for that. If you have any questions, feel free to leave a comment. I'll respond to every message. See you next time.